Sam Bankman-Fried was considered a sort of white knight of cryptocurrency traders, often credited for swooping in to support flailing industry players. The 30-year-old billionaire, who had amassed a fortune once estimated at around $25 billion, wound up shocking the digital assets world by declaring that his giant FTX exchange was filing for bankruptcy. FTX was founded in 2019 and at its zenith ranked as the third biggest crypto exchange in the world in terms of trading volume. The announcement of its bankruptcy filing came as news that some $473 million was suspected to have been stolen from the exchange. It's probably also worth noting that several established traditional investment firms trying to jump on the crypto trading wave, such as BlackRock and Sequoia Capital, were key backers of FTX. In fact, the Wall Street Journal has reported that FTX's collapse was preceded by the lending of billions of dollars worth of customer assets to fund Alameda, which, of course, is a Bankman-Fried supported crypto hedge fund. According to reports by CNN Business, industry insiders compared the downfall of FTX to a Lehman-like moment in the cryptocurrency world. They were referring, of course, to the fall in 2008 of the investment bank Lehman Brothers that sent shockwaves around the world and helped spark a global financial crisis. The silver lining from such a rather stunning episode at FTX is that more people might become aware of the very real dangers of trading in the realm of Ether and the rest. Along these lines, we are fortunate today to have with us Kevin Green, a senior researcher and vice president at Dimensional Fund Advisors. Hi, Kevin. Thanks for weighing in on this important topic.
Yeah, Murray, pleasure to be here. Glad to speak with you today and talk about something that I think is certainly top of mind for many.
Yeah. Let's start off by giving our viewers a sense of how Dimensional views the risks of trading in digital currencies.
Yeah, I think, Murray, for a lot of reasons, it's important in our mind to separate the technology behind cryptocurrencies from the digital currencies themselves. I think for many of us, there's a lot of excitement and strong appeal from an economic standpoint about blockchain technology and how that might help advance the global economy forward in ways through supply chain management or other uses that is apart from how it's being used currently on the topic that we're discussing, which is cryptocurrencies. And I think that's a very important consideration of thinking about how you might, if you're interested in the technology itself, gain exposure. In many ways, you probably likely already have exposure through your equity investments and through some of the actions that corporations are taking to integrate the technology in question into their day-to-day operations with the goal of providing an economic benefit that in turn would be something that investors benefit from as a part of their current equity holdings that they have in their portfolio. Now, that same technology has been used to create these new forms of digital currencies we call cryptocurrencies. And I think when investors are making a consideration of what type of role that asset class may have in their portfolio, I believe there's a number of things that we like to highlight from Dimensional's perspective that align with just kind of the common considerations that you would want to take when evaluating any asset as to whether or not it has a place in your portfolio.
Yeah, and excuse me, just to jump off, you are distinguishing between the Bitcoin technology and the public ledgers called blockchain technology, correct?
Exactly. So the digital ledger that allows for secure transactions in a digital way that remains in how I like to describe almost frozen in time to help ease some of the costs with tracking, for example, shipments and the supply chain issue. That blockchain technology, I think, does have a lot of potential and value add. And we've already seen companies start to integrate that into their processes as a way to improve their supply chain management. Now, that same technology is being used as the backbone, if you will, behind these cryptocurrencies. And I think it's just important to identify what its role may be in the broader economy versus how it's playing a role here for the cryptocurrencies, and whether or not that distinction is being made when considering this as an asset class allocation.
Sure. And cryptocurrencies, of course, don't have any expected returns, correct?
Well, that's how we like to, generally we think about investing in stocks or bonds, right? If we're investing in stocks, right, we have a residual claim on those assets, and we expect, whether or not it's today or some point in the future, to generate cash flows as a shareholder as a part of that investment. And the same approach when you think about a fixed income investment, right? You're making an investment, buying that fixed income security with the knowledge that you have this set of income that is coming your way as a part of that investment. Now, if we think about, let's just eliminate crypto from the currency description and just think about investing in currencies in general. It's not clear that if I hold dollars today, there's no guarantee that I'm going to get additional dollars tomorrow. I have a dollar in my pocket. Well, tomorrow I'm not going to receive an additional quarter, if you will, as a part of holding on to that dollar. If it's worth $1 today, I'm going to continue to have $1 in my pocket tomorrow. And that same framework of how we think about, the expected return for currencies also applies here, in the sense of we just evaluate whether or not we should expect to generate a positive return associated with these cryptocurrencies. There's no framework or residual claim in place here that would allow us to generally expect to receive some form of additional, whether it be Bitcoin or one of the other cryptocurrencies in the future, as a result of our holding of that asset class today. Really, what the bet is that the price people are willing to pay today is less than the price someone's going to be willing to pay me tomorrow. And that's really where a lot of the speculation around whether or not an investment today would generate a positive expected return tomorrow, that's the framework you have to, in some ways, rely on, is that the supply and demand in the future is going to be, or the demand in the future is going to be greater than it is today. Thereby, I will generate additional income from the form of a higher valuation of that cryptocurrency basis today. But there's no guarantee for that. There's no structure in place to suggest that we should expect that to be the case, that what I pay for example, Bitcoin today is going to be less than what I would maybe receive for it tomorrow.
And also future regulation adds to this uncertainty, doesn't it? Especially in the case of FTX.
It does add to the uncertainty. Broadly speaking, it's a nascent industry, a young adoption of a new form of technology into the marketplace. It's really uncertain as of now how this is going to play out. Largely speaking, a lot of the cryptocurrencies on the market today are unregulated. But that doesn't mean some new form of digital currency may come about at some point that's backed by, for example, the US government. It's really unclear exactly what the digital currency of the future will look like compared to what we see today. And with that uncertainty, I mean, oftentimes what you'd like to see is that there's a broad array of investments to participate in, a way to diversify your allocation if you're thinking about this space as a way to account for that uncertainty. And what we largely see when we think about digital currencies is it's pretty concentrated. If you just look at the largest 5 names in the space, they account for about 80% or so of the market value of the cryptocurrency landscape. So you're really talking about making a concentrated wager, almost, if you will, of which one of these players may come to either dominate the space or in some case may be something that we think about as being a fad or something of that nature. It's really not crystal clear exactly what this technology will evolve into going forward.
The popularity still keeps going up, especially by younger investors. And there are even reports now that several large foundations, charitable trusts, even some investment advisors to 401k and other retirement plan systems have started to at least consider advising plan sponsors and foundations to put assets aside and trade in this volatile marketplace. Could this prove to be an especially worrisome development in the world of retirement as well as nonprofit investing?
Maria, I'd be careful to draw a strong conclusion of whether or not that's worrisome or not. I think having an interest in the asset class in general is not necessarily a bad thing. It is a new technology that does offer a lot of promise. whether that's in a digital currency form or in some other type of technological breakthrough that is applied broadwide. So an interest in and of itself, I think, is not particularly troublesome. And I would expect there to be a reaction to a lot of demand from the client side of whether or not that would be an available investment vehicle to invest in. I think, as the importance of the advisor is really what comes into play there, and helping guide and understand what the trade-offs would be associated with an investment in cryptocurrencies. And there's a lot of kind of, I would say, characteristics that are associated at times that you hear with cryptocurrencies that may not be true when you actually look at the data. One of which is that cryptocurrencies might provide a nice alternative, or if you think of it as a diversification vehicle for an investment in equity assets. When we look at the short history of cryptocurrencies, in particular, if we were to focus on Bitcoin, just over the last 10 years, we've seen declines in excess of 70%, 5 separate occasions. So that type of volatility is something that an investor needs to be aware of if they're thinking about having an asset allocation to this place. So an interest by itself is maybe not worrisome, but absentmindedly, if you will, making an allocation into cryptocurrencies without an understanding of what those volatility characteristics are and what implications that may have for your portfolio is something that we certainly would expect for advisors to have a strong role in educating their clients as to whether or not it makes sense to be a part of the broader asset allocation.
But what are you investing in? I mean, even if these reports are early, if there are retirement plans, foundations, charitable trusts, anybody investing in cryptocurrencies, they're not investing anything with definable expectable returns. They're not investing in anything with any definable cost of capital or definable supply and demand curves. What are you exactly suggesting that people might be open to investing in cryptocurrencies for?
Yeah, Murray, I definitely agree with you. There's a lot of uncertainty around how you would form a rational expectation around what the expected returns for this asset class would be. I think there's a lot of concern around the volatility characteristics that we've observed over the short lifespan and how that could impact a portfolio as a part of the asset allocation. All of those concerns remain in place. And even if someone is willing to take on those trade-offs and make an investment in this space, I think one thing that's even more important is think about what the size of that asset allocation would be. And if we look at the size of this market in aggregate in comparison to the overall global equity and fixed income space, is less than 0.5%. So even if you're okay with accepting the risk of uncertainty around expected returns, willing to accept the risk associated with the volatility that we observed in this asset class, you just have a preference and a desire to have some exposure to this area of the market, the type of asset allocation you'd want to make. If you're thinking about asset weights driving that decision-making, it's a very small percentage of your overall portfolio. Otherwise, deviating from that is going to introduce quite a bit of tracking error in your portfolio relative to what you observe from a day-to-day basis in the overall marketplace. So even if someone is willing to accept the trade-offs that we've highlighted, certainty over expected return, and those strong volatility characteristics, the lack of ability to truly diversify across this space, even if you're able to do all of that, the type of asset allocation you make should be very, very small as a proportion to your overall assets in your portfolio.
And again, if you trade in cryptocurrencies, you're not investing in anything. You're not investing in a company that's producing goods or services or reporting profits, hiring, firing people. You're investing in a basic trading vehicle.
You are investing in something that they again agree has uncertainty around whether or not you should deliver positive expected returns. There's even some, considerations. This may be something of where you're going to actually store them. I mean, we've seen this bankruptcies with most recently, but we've also seen cases where other exchanges have been victims of theft, where lots of cryptocurrencies were stolen from the exchange, which represented assets that somebody had invested in place. We've even seen situations where someone has held onto their cryptocurrencies in their own personal digital wallet, which required some type of password verification to actually access those assets, in which case they were actually locked out and prevented them from being able to access this. So there's a number of frictions in place that are a part of this vehicle that people should be considerate of when thinking about whether or not they should make an investment in the space, beyond just the concerns that you've highlighted around whether or not there should be any expectation that you should have a positive return associated with an asset allocation to cryptocurrencies.
Okay. Well, thank you very much for your time today, Kevin.
Hey, Murray, absolute pleasure to be here. I know, again, that you're probably receiving many questions around this, and I think we basically see eye to eye on whether or not this represents a viable investment class for your portfolio. And the trade-offs we've highlighted, from strong volatility, uncertainty around expected returns, are really important for folks to understand and consider when thinking about whether or not this has a place in their portfolio.
Okay. Thank you very much.
I appreciate it, Murray.